Good morning, and welcome to Parker-Hannifin Corporation's fiscal 2026 first quarter earnings conference call and webcast. At this time, all participants are in a listen-only mode. After the prepared remarks, there will be a question-and-answer session. To ask a question during this period, you will need to press star one on your telephone keypad. If you want to remove yourself from the queue, please press star two. Please be advised that today's conference is being recorded. If you should need operator assistance, please press star zero. I would now like to turn the call over to Todd Leombruno, Chief Financial Officer. Please go ahead.
Thank you, Chloe. Good morning, everyone, and welcome to Parker's fiscal year 2026 first quarter earnings release webcast. This is Todd Leombruno, Chief Financial Officer speaking, and with me today is Jenny Parmentier, our Chairman and Chief Executive Officer. And always, we appreciate your interest in Parker, and thank you for joining us today. We address our disclosures on forward-looking projections and non-GAAP financial measures on slide 2. Items listed here could cause actual results to vary from our forecast. Our press release was released this morning along with this presentation and reconciliations for all non-GAAP financial measures. Those are available on our website under the Investors section on parker.com. The agenda for today has Jenny starting with an overview of our record FY26 first quarter performance. She will share some highlights from our Day 1 celebrations, welcoming the Curtis team members to Parker. Jenny will also then reiterate the strengths of our interconnected portfolio and share an example from our energy market vertical. I will follow Jenny with more details on our strong first quarter results, and then we'll both provide some color on our increase to our FY26 guidance. After that, we will move to the Q&A portion of the call and address as many questions as possible within the hour. I now call your attention to slide 3, and Jenny, I will hand it over to you.
Thank you, Todd, and thank you to everyone for attending the call today. Q1 was a great start to the fiscal year. Operational excellence was on full display, powered by the Win Strategy. We achieved top quartile safety performance with a 20% reduction in our reportable incident rate. This performance is aligned with our goal to be the safest industrial company in the world. Our team delivered record Q1 sales of $5.1 billion, organic growth of 5%, and 170 basis points of margin expansion, resulting in 27.4% adjusted segment operating margin. Adjusted earnings per share grew 16%, and cash flow from operations was $782 million. And we completed the acquisition of Curtis Instruments. Next slide, please. A long-standing practice within Parker is for a Parker leader to personally welcome the new team at every location. This slide shows pictures from our Day 1 events held around the world, welcoming the Curtis team to Parker. This was a great day for all of us, and we are thrilled to have Curtis in the Parker portfolio. Next slide, please. Obviously, we are very proud of the Q1 results delivered by our team and equally excited about our future. So just a reminder on why we win. First, the Win Strategy is our business system. We have a decentralized operating structure, 85 divisions run by general managers with full P&L responsibility, acting like owners, close to their customers and executing the Win Strategy every day. Next, we have innovative products that solve customer problems, 85% covered by intellectual property. Our application engineers provide the expertise that allows us to have a competitive advantage with our interconnected technologies that provide efficient solutions for our customers. And finally, our distribution network is the envy of the competition and the best in the world. It took us over 60 years to build it, and it is truly an extension of our engineering teams, providing solutions to all of those small to mid-sized OEMs that are participating in capital spending and investments. These partners are experts at applying our interconnected technology. Next slide, please. One position in the $145 billion motion and control industry, a growing space where we continue to gain share. These 6 market verticals represent greater than 90% of the company's revenue. Our interconnected technologies cut across these market verticals and give us a clear competitive advantage. 2/3 of our revenue comes from customers who buy 4 or more technologies, and our growth is focused on faster-growing, longer-cycle markets and secular trends. Next slide, please. This slide focuses on our presence in the energy market vertical. Parker is a significant supplier of products into heavy-duty gas turbines used for electrical power generation. We bring both proprietary designs and world-class manufacturing capabilities to offer a comprehensive suite of interconnected technologies. Parker supports multiple global industry-leading customers, and we are seeing significant growth in this space. This business is long life cycle with multi-year backlog and durable aftermarket. This is a great example of products and technology that are shared across aerospace and industrial markets. I'll hand it back to Todd to go through our first quarter highlights.
Thank you, Jenny. This was a great start to the fiscal year. I'm on slide 9, and I will start with a summary of our Q1 results. Once again, and I love saying this, every number in the gold column on this slide is a record. It was just a fantastic quarter where mid-single-digit sales growth combined with strong margin expansion, resulting in mid-teens EPS growth. Sales were up 4% versus prior. Organic growth was positive at plus 5%. Currency was favorable at 1%, and divestitures were 2% unfavorable. Those are the divestitures that we previously completed, and I would just note this is the last full quarter that we will have a full quarter of divestiture impact. Moving to adjusted segment operating margins, as Jenny said, we did 27.4. That's an increase of 170 basis points versus prior year. Adjusted EBITDA margin was 27.3. That was up 240 basis points. And adjusted net income was $927 million, or 18.2% return on sales. All of this drove adjusted earnings per share up 16% to reach a record $7.22 per share. It was a really nice start to the fiscal year with strong quarter across the board, and it gives us confidence for the remainder of the fiscal year. Our global team members really continue to drive results enabled by the power of the Win Strategy. If we could jump to slide 10, you'll see a bridge on the year-over-year improvement in adjusted EPS. The majority of our EPS growth came from continued strength across our operations as segment operating income dollars increased by $132 million, or 10%. That contributed 80 cents to our EPS growth this quarter. Corporate G&A and other were favorable 18 cents. That was primarily due to foreign currency exchange in the prior period quarter last year. That was unfavorable last year. It created a favorable for this year. Interest expense was also favorable by 7 cents, and that's driven by lower average debt balances across the quarter and lower interest rates across the quarter. Share count was 13 cents favorable, and that was driven by the discretionary share repurchases that we completed over the last 3 quarters. Income tax was unfavorable by 16 cents, and that was really simply due to a few favorable discrete items in the prior period that did not repeat. And that is basically it, a really clean bridge to the 16% increase in adjusted EPS. This record was really achieved by strong sales growth across the board, margin expansion, and great adherence to cost controls across the company. If we move to slide 11, we'll just talk about the segment performance. Orders were strong at +8 versus prior year, with order rates increasing across all reported segments. Organic growth came in at +5%. This was the first time in 2 years we've had positive organic growth across all of our businesses, as diversified industrial organic growth turned positive. Every business delivered record adjusted segment operating margins, resulting in great incrementals and that 170 basis points of margin expansion. Looking specifically at the diversified industrial North America businesses, sales were over $2 billion with organic growth positive at 2%. That's the first time in 7 quarters North America posted a positive organic growth number. That was better than our expectations going into the quarter. We continue to see gradual improvement across market verticals with positive growth driven by the aerospace and defense businesses in industrial North America, in the in-plant and industrial equipment vertical, and also improvement in off-highway that exceeded expectations. If you look at North America, they also had 170 basis points of margin expansion and reached a record 27.7% segment operating margin. That was really driven by higher productivity, some new business wins at great margins, and margin mix with strong aftermarket across all those businesses in North America. And North American orders increased sequentially to +3 versus prior year. Looking at the diversified industrial international businesses, sales were up. They were a record of $1.4 billion, up 3% versus prior. Organic growth remained positive at +1. Looking at Asia Pacific, that was our strongest region with a +6. EMEA remained down at -3, and Latin America was flat versus prior year. So Asia Pac really drove the outperformance of the growth in the international businesses. Adjusted segment operating margins were also a record at 25.0. That is a 90 basis point improvement from prior year. And I can't say this enough, our international teams continue to show great resilience. They're driving margin expansion, and it's really great cost controls, and they're really executing the Win Strategy to great success. International orders rebounded. They improved to +6 after a flat Q4. Both EMEA and Asia Pac had positive orders this quarter. And lastly, Aerospace Systems, just another exceptional quarter from this group. Sales were a record $1.6 billion. That's an increase of 13% versus prior. Organic growth of 13%. That's the 11th quarter in a row that we've had double-digit organic growth for aerospace. Commercial OEM is the strongest market segment, growing 24% versus prior year. Adjusted segment operating margins increased by 210 basis points, and I'm proud to say reached 30% for the first time ever. Record top line, productivity, continued aftermarket strength all drove the margin expansion, and aerospace orders continue to be impressive, increasing +15%, and backlog also reached a new level, record level for aerospace. There's just robust demand, and that continues across all of our aero and defense markets. It's great to be in the aerospace business right now. If we move to slide 12, let's look at our cash flow performance. Cash flow from operations, a record, $782 million. That's 15.4% of sales. That's up 5% versus prior year. Free cash flow is $693 million. That is 13.6% of sales. That is up 7% versus prior year. Cash flow conversion for the quarter is at 86%. I just want to remind everybody, I think everyone knows this, but our cash flow is historically second half weighted. We remain committed to free cash flow conversion of greater than 100% for the year. And lastly, on this slide, we did repurchase $475 million of shares on a discretionary basis within the quarter. That is a wrap on Q1, and Jenny, I'm going to turn it back to you on slide 14, and we'll move on to our updated fiscal year guidance.
Thank you, Todd. This slide shows our updated fiscal year 26 organic sales growth forecast by key market vertical. In aerospace, we are increasing our forecast from 8% to 9.5% organic growth. We continue to see strength in commercial OEM and aftermarket. In-plant and industrial remains the same as our initial guidance at positive low single-digit organic growth. The sentiment does remain positive with continued quoting activity, while customer CapEx spending remains selective. Transportation is our most challenged market this year. Forecast stays the same at mid-single-digit organic decline. We are increasing the off-highway forecast from negative low single-digit to neutral. We see gradual recovery progress in construction, while the ag challenges do persist. We are maintaining energy at positive low single-digit growth with robust power gen activity offset by oil and gas. And we are increasing HVAC refrigeration from positive low single-digit to positive mid-single-digit. We see strength in commercial, refrigeration, and filtration with some nice new business wins with our filtration technology. As a result of these changes, we are increasing our organic sales growth guidance from 3% to 4% at the midpoint. I'll give it back to Todd for some more guidance details.
Thanks, Jenny. I'm on slide 15 with just some of those details. In respect to reported sales, we are increasing the range to 4 to 7 or 5.5% at the midpoint. Currency is expected to be favorable 1.5 points, and that is based on September 30th spot rates. Now that we have the acquisition of Curtis closed, we are including sales and segment operating income from Curtis in our guide. We have added $235 million to our guide for the remainder of the year. That is approximately 1% of sales. And divestitures that we've already previously completed are 1% unfavorable. If you move to organic growth, the forecast is now increased to a range of 2.5 to 5.5 or 4% at the midpoint. We have increased aerospace organic growth to 9.5% at the midpoint. And for the diversified industrial segment, we have increased North America organic growth for the year to +2. And for international, we still expect organic growth to be 1% at the midpoint. We are raising adjusted segment operating margins. So we're raising that 50 basis points to 27.0 for the year. That is now a forecasted increase of 90 basis points versus prior year. And incrementals are now forecasted to be approximately 40% for the full year. Just a few additional items. Corporate G&A is unchanged at $200 million. Interest expense has been increased by $30 million. We now expect $420 million for the full year, and that is driven solely by the funding of the Curtis acquisition. And other expenses just slightly up to $90 million from $80 million last quarter. Full year tax rate, we expect 22.5%. And we are raising adjusted earnings per share to an even $30 at the midpoint. That would be a 10% increase versus prior year. The range on that EPS is plus or minus 40 cents on either side, and the split is 48-52, first half, second half. In respect to full year free cash flow, we're also raising our guidance there to a range of $3.1 billion to $3.5 billion, with conversion, like I said, greater than 100%. And finally, looking specifically at Q2 for FY26, we expect organic growth to be, reported sales are expected to be 6.5%. Organic growth is expected to be 4%. Adjusted segment operating margins 26.6%. And EPS for the second quarter on an adjusted basis is $7.10. As usual, we have some additional details in the appendix. And really just in summary, FY26 is off to a great start. And that gives us confidence to raise full year guidance for sales, margin, EPS, and free cash flow. With that, I ask you to move to slide 16, and Jenny, I'll turn it back to you.
Thanks, Ted. And a reminder on what drives Parker. Safety, engagement, and ownership are the foundation of our culture. It's our people and living up to our purpose that drives top quartile performance that allows us to be great generators and deployers of cash. Back to you.
All right, Chloe, we are ready to begin the Q&A session, so we'll take the first question.
Thank you. As a reminder, to ask a question, please press star 1 on your telephone keypad. To withdraw your question, press star 2. So others can hear your questions clearly, we ask that you pick up your handset for best sound quality. We'll take our first question from Julian Mitchell with Barclays. Your line is open.
Hi, good morning. Just wanted to start off perhaps with the organic sales picture in the DI North America business. Maybe help us understand a little bit better the cadence of demand. It did seem to surprise you positively, I think, in the quarter. How has demand moved there in recent months? And then when we're looking at the full year guide, I think your midpoint for DI North America doesn't embed any acceleration from the September quarter growth rate. Just wondered the thinking there.
Okay. Good morning, Julian. So yes, we're very pleased with the performance. We had guided to a negative 1.5% and came in at a positive 2%. So North America performed better than expected with the aerospace and defense business that sits inside of our industrial businesses, distribution, HVAC, and electronics. Construction continued to outperform versus our expectations. And margin expansion from higher productivity on slightly stronger volume really helped us. We had some project wins that attracted margins. And, we're getting a margin mix benefit with the lower industrial OE and a very resilient aftermarket. So you are right. We do expect Q2 to be much like Q1, coming in at 2%. So that was, prior, as Todd stated, for the year, we were looking at a total of 1%. So, as I was just talking about what we saw in Q1, we do believe that industrial, aerospace, and defense will remain strong. We're still talking about a gradual in-plant industrial recovery. Certainly positive sentiment from our distribution channel continues. Quoting activity is good, but as I commented earlier, still customers are being very selective on their projects and their CapEx spending. We still see transportation challenged in automotive and trucks, so we don't expect the truck recovery this fiscal year, but we will see some benefit from the aftermarket. In off-highway, gradual recovery progress in construction, but ag challenges still persist. Energy, power gen, robust, but oil and gas upstream, still weak. And, we're HVAC and refrigeration. We're coming off a very strong fiscal year, and we have increased that for the rest of the year. So while some markets are increasing, not all of them are, and that's why we see Q2 pretty much the same as Q1, but an increase for the total year.
Hey, Julian, I would just add, Jenny covered the organic growth piece perfectly, but I would just add on a margin standpoint, we did increase diversified industrial North America margins 70 basis points for the full year versus our previous guide. So the teams are converting on that, and I have great confidence that they'll be able to do that.
Yeah, and Q2's margin is 150 basis points higher than prior year.
Right.
That's helpful. Thank you. And just following up on that last point, perhaps, so understand that you've had a higher margin performance year on year for the total company than is guided for the full year. I assume that's just sort of natural conservatism, given we're early in the year. Wondered if there was any other factors to think about. And allied to that, your Q2 EPS guide is a decline sequentially, which is quite unusual in Q2. Any color on that, please?
Well, I think, we left the second half pretty much alone. So based on what we see today, we feel really good about Q2, and I think we'll have a better line of sight here after the first of the year.
Yeah, Julian, Q2, sequentially, it usually is our softest top line. I think the EPS is just pulling off of that. Nothing out of the normal that we see.
Great. Thank you.
Thanks.
We'll move next to Mig Dobre with Baird. Your line is open.
Thank you for taking the question. Good morning. I would like to talk a little bit about Industrial International. The orders there were quite good and frankly better than what I would guess. A little bit of update in terms of what you're seeing in various geographies. And related to this, if I look at the past 4 quarters, I think your order intake averaged about 5%. So it's quite a bit better than what you have embedded in your forward outlook for organic growth. So I'm kind of curious, at what point in time do we start to see these higher orders really flow through organic growth in this sector?
Yeah. Good morning, Mig. So, with Industrial International orders, they've been really choppy, as we often say. If you go back to our Q3, we had a plus 11%, and then Q4 we went flat, and that was because we had some one-time long cycle orders that didn't repeat in Q4. So, it's really not an average of about 5%. So what we're seeing in the region is, if we look at EMEA, we're showing flat to slightly positive organic growth for the fiscal year. There's uncertainty that's remaining, and we're expecting a slow in-plant industrial recovery. We do expect to see some growth in energy. We are seeing some mining recovery underway. And we do think that there'll be some pickup from the stimulus and future defense spending, but that's not, something that we think we're going to benefit from this year. So What we see in EMEA is, really to remain flat to slightly positive with what we see on the orders right now. In Asia Pacific, we have positive low single-digit organic growth for the fiscal year. We continue to see strong electronics and semicon demand. Implant is mixed as delays continue in China, but we do see some slight growth in India and Japan. Seeing some mining and transportation improvement in China, but I think there's still some continued uncertainty from tariffs across this market. So this is what we're seeing today on industrial international. I mean, we look forward to the time when this will be a higher organic growth.
Understood. Then my follow-up, and I don't know if you can answer this question, Jenny. It's kind of in the weeds. You talk about the ag market where challenges persist, but I do wonder, in terms of your exposure, if you sort of separate out the large ag equipment, so high horsepower tractors, combines versus mid-size and lower horsepower, I'm just wondering kind of what your exposure looks like there, because I am starting to see a bit of a divergence forming where large ag, as you say, it's challenged, but some of these smaller tractors are starting to grow in terms of volumes, and the volumes are actually much higher in lower horsepower equipment than large ag. So I'm wondering if this end market might turn a little bit sooner than maybe we're thinking about when we're thinking about large ag. Thank you.
When we talked about ag last quarter, I made the comment that we thought that market had kind of hit trough, and I would say it's broad-based when we look at ag between that equipment, but you can certainly follow up with Jeff on maybe more details in one of the follow-up calls.
Yeah, Vic, I would just add, when we look at ag, it's 4% of total company sales, so it's just become a smaller piece of the total pie. It is broad-based. There's aftermarket, there's the OEM side of it. So I don't know if I'd read too much into movements there.
Okay, thank you.
We'll take our next question from David Raso with Evercore ISI. Your line is open.
Hi, thank you. Of the organic guide raise, how much was volume versus a change in price? And of the 50 bips margin improvement, can you give us a sense of how much is that, maybe related to the answer to the first question, volume improvement versus maybe price cost different than you originally expected for the year? Thank you.
Good morning, David. Well, as you know, we don't disclose pricing. Regardless of pricing or volume, I think that we've shown that we can expand margins pretty much in any climate. We have had 2 years of negative industrial growth, and we're seeing the gradual industrial recovery playing out with industrial organic growth now positive in Q1. So we're definitely seeing the impact of slightly stronger volume.
That's great. Thank you very much. Appreciate it.
Thanks, David.
We'll move next to Scott Davis with Melius Research. Your line is open.
Hey, good morning, Jenny and Todd and Jeff.
Good morning.
I got to ask about M&A. I probably do a lot of quarters, but I'm gonna lead with it anyways because it's been a few years since you closed Meggitt, and obviously that's such a great deal for you guys. But Curtis seems like an interesting deal too. It's just not as big as maybe some of those others. So can you just update us on your pipeline and such?
You bet. So obviously we're committed to actively deploying our capital. And as you mentioned, we did close Curtis Instruments in September, and we're really excited about that. And moving forward, the strategy remains the same with plenty of optionality. So when it comes to capital deployment, obviously we prefer acquisitions, but it has to be strategic and disciplined. You've heard me talk about this criteria before. And I would tell you that the pipeline, the relationships, and the analysis continues to be very active. While sometimes timing is hard to predict, we are working it. And, we want to continue to acquire companies where we're the clear best owner. And we feel like we have a strong competitive advantage with our interconnected technologies, and that's what we want to add to the portfolio. So still looking for those deals that are accretive to growth, resiliency, margins, cash flow, and EPS. And as I've said many times before, the pipeline has deals of all sizes.
We'll take our next question from Amit Mehrotra with UBS. Your line is open.
Thanks, operator. Hi, everybody. Still morning. Good morning. Obviously it was, I guess, nice to see the order improvement. Jenny, quick question about, just the broad baseness of that. I mean, are we seeing a broader activity and pickup? You also won, I think I saw this somewhere, you guys won a large contract to supply components for aeroderivative gas turbines. I'm just trying to get a sense of, are we seeing broad-based green shoots here, or is it mostly explained by the longer cycle pockets that kind of have been working for a while?
We have the longer cycle pockets, but then we're also seeing, some improvement in some of our other key verticals. So when you look at the change that we had in the guide this month, we took aerospace and defense up. We also moved off-highway from negative low single digit to neutral, and we increased HVAC and refrigeration from low single digit to positive mid-single digit. So we are seeing some pockets within those industrial businesses where we're seeing some growth.
Okay, and the other question I have is on aerospace margins. Obviously, just really good. One thing I noticed is obviously the incremental margins being so high despite OE revenue up 20%, which I would imagine would be a little bit mixed dilutive. As the OE build cycles continues to improve, can we talk about, what the mix impact is on aero margins going forward? Because it seems to defy gravity in the quarter.
Yeah, well, we did have 51% OEM and 49% aftermarket in the quarter, and we do anticipate that that's going to be the mix for the rest of the year. Aero margins are very strong in Q1, and we had a nice bit of spares in Q1, which is really nice margin for us. So that helped us reach that record 30%, hit 30% for the first time. Going forward, we're very confident in our ability to maintain the margins where we've been and go forward with strong margins. If you look at what we did with the guide, we have full year at 29.5% now. That's 100 basis points higher than prior year, and that was raised 60 basis points from the initial guide. Q2, we're forecasting 29.1%, and that's 90 basis points higher than previous year. So we're in a good spot with aerospace. Our teams are doing an excellent job, executing the Win Strategy and really benefiting from this volume.
Got it. Okay, congrats. Thank you, guys.
Thank you.
Appreciate it.
We'll move next to Jeff Sprague with Vertical Research Partners. Your line is open.
Hey, thank you. Good morning, everyone. Hey, can we just cut a little further into aerospace, and also, Jenny, maybe just a little bit of color on kind of how you see the defense side playing out in 2026 versus the commercial side. Any change of thinking there?
So, Jeff, I'm sorry. What was you wanted to dig deeper into aero, especially defense, right?
Yeah. I wanted to kind of get a sense of defense versus commercial mix and how that's playing, and if that's changed versus your initial view.
Yeah, we came out with mid-single digit growth for both defense OEM and MRO, and that's the same. We're not forecasting any change there.
And then great. And then just on Curtis, I think it comes in a bit margin dilutive. It's not apparent given kind of all the other execution and everything that's going on. But can you just kind of give us a little color on at the margin rate it comes in at, the work you're doing to integrate it, and any thoughts on, how it might be positioned into next year after you've got it kind of fully digested?
Yeah, Jeff, this is Todd. I can take that. I mentioned earlier we added about $235 million of sales into the guide. You're right, it is slightly dilutive, but it's smaller, so it doesn't really have an impact. You can see we did raise both North America and international margins for the full year, even after including Curtis into the mix. If you're looking for a number, I would say high teens, low 20s would be a good number to use. It does add, it is EPS accretive in the stub year even. You saw that we added $30 million for interest there, and it's only been a little over a month. The team is super excited about it. Jenny mentioned the welcoming day, and I can tell you they're working really hard to integrate and make this part of Parker, just like we have on the last deals.
It does. I would just add that, as Todd said, the integration's well underway. Very similar. We've assembled a dedicated integration leader and a team of high talent team members, and this is how we ensure a very smooth integration.
Okay, thanks. I'll leave it there.
Thanks, Jeff.
Thanks, Jeff.
We'll move next to Joe Ritchie with Goldman Sachs. Your line is open.
Hey, guys. Good morning.
Hey, Joe.
Hey, Jenny and/or Todd, is there a way that you could maybe, size the opportunity on slide 7 or give some color just around like what the growth rates have looked like? I'm just curious how to think about this business for you guys going forward.
Well, I don't think we're in a position to go over the growth rates, but what's great about this power gen business is that we do have this suite of interconnected technologies for power gen applications, and you can see on that slide all the different examples of the products that we have, and it's just a very robust order book. Like I commented, multi-year. We expect solid growth for years to come. And we're working with all of the leading industry customers. So while this market vertical makes up about 7% of our sales and power gen is about half of that, it's a small percent overall, but a very nice growth area for us. And we expect to not only continue to win in this market, but really benefit from it.
Yeah, that's great to see, and glad that you guys highlighted it. Other quick question. I know that we won't be talking specifically around pricing, but in an environment, let's say, where you do see some of these tariffs potentially getting rolled back, like how does that impact the pricing that you've already put through, and then ultimately, is that another potential boost to margins if we do see some pullback on tariffs?
Well, obviously, as we've talked about tariffs, we have the analytics and the processes to navigate and act quickly up or down, and we've had to do a lot of that over the last several months, and the teams have just done a fantastic job. So we have a strong muscle when it comes to pricing and to price cost, and we'll adjust as we need to. But as I've stated, time and time again, we can't use tariff as a margin expansion device. This is something that we have to recover from a cost standpoint, and we'll adjust as we need to going forward.
Okay, great. Thank you.
We'll take our next question from Joe O'Dea with Wells Fargo. Your line is open.
Hi, good morning. Thanks for taking my questions. Wanted to start on the North America in-plant side of things and what you're seeing from customer activity or what you're hearing from dealers with respect to greenfield and brownfield investment in the U.S. And then around that, whether you're getting any color on the nature of those investments and kind of local for local, or you're seeing more kind of foreign participants looking to invest in the U.S.
Yeah, I don't have the detail too much for local versus foreign investment, but I would tell you, my comment earlier about the CapEx being selective. I do believe it's still selective, but in the past, we were just talking about delays, and obviously we saw a stronger area there through distribution and in-plant in Q1. So, we're seeing some things get across the line and projects get started, but I don't have a specific breakdown for you at this time.
And then on the HVAC side of things and seeing some strength in commercial refrigeration and filtration, I think you talked about some nice new wins in filtration. Can you just expand on that a little bit in terms of kind of verticals you're serving there, where you're seeing some of that strength?
Yeah. We've had some nice filtration wins when it comes to gas turbines. We have some proprietary technologies, really nice filtration products in the energy market. And then we've also had some nice filtration wins on actually on the mobile side of the business as well. So it's been a growth area for our filtration group this past year.
Great. I appreciate it. Thank you.
We'll move next to Christopher Snyder with Morgan Stanley. Your line is open.
Thank you. So, obviously North America industrial turned organic positive in the quarter. I'd imagine there's some, benefit of incremental price, and it does sound like some of the longer cycle verticals kind of helped that. But I guess my question is when you look at North America industrial, the more cyclical pieces, do you feel like the cycle's starting to get better?
Yeah, I would definitely say that Q1 is evidence of that, right? And especially those key market verticals where we've increased our outlook for the year. So, yes, I would definitely say we're starting to see that.
Yeah, Chris, I was just
Thank you. I appreciate that.
I was just going to add, Chris, that we've talked about inventory across the channel, and we feel that it's kind of at a trough level. Can't say that we've seen a restocking yet, but it feels like we're closer to that than going the other direction.
Yeah, no, happy to hear that. You talked about in-plant, as being, one of the industrial verticals doing well, showing momentum. Do you have any color to provide on how that business did in the U.S. versus the international markets, just to get a sense if, some of the policy is driving activity into the U.S.? Thank you.
In North America, as I commented before, it's a gradual in-plant industrial recovery. But as Todd was just saying, although we don't see restocking yet, we still have that very positive sentiment from our distribution channel and a lot of quoting activity. When we talk about EMEA, it's still some uncertainty that remains. So we're expecting a slow in-plant industrial recovery. When we look to Asia Pacific, it's kind of mixed. Delays continue in China, but there's been some growth in India and Japan.
Thank you. I appreciate that.
Thanks, Chris.
We'll take our next question from Jeff Hammond with KeyBanc Capital Markets. Your line is open.
Hey, good morning. Maybe just, at the Analyst Day, you called out data center, and I know, clearly power gen probably benefiting from that, but maybe just update us on what you're seeing on the liquid cooling side. Clearly, we're seeing some pretty mind-boggling order rates from certainly peers, et cetera.
Yeah, so we do have nice exposure, and we are seeing rapid growth, but this is not yet large enough for us to call it its own market vertical. It still makes up less than 1% of our sales. But again, this is something what I feel is unique about Parker, and it's these interconnected technologies and this competitive advantage. We can provide great value to our customers in this space. We have the products that they need for the data center cooling, and we have been working with all the industry leaders. So our ability to provide liquid cooling systems and subsystem components has really given us, I think, a nice position here.
Okay, just a couple housekeeping. One on the Curtis revenue. Can you give us a split between North American and international, kind of how that flows through the two segments? And then just, you've been more active on buyback. I'm assuming the guide doesn't build in any more buyback, but correct me if I'm wrong.
Yeah, Jeff, I'll take those. The sales is split almost 50-50, North America, international. I think we'll refine that as we get further on in the integration process, but right now that's kind of how we're modeling it. And then you're right. Over the last 3 quarters, we have done some share buyback. I think we finished the quarter with a net debt to adjusted EBITDA of 1.8. So we're well below our target of 2. That's even after funding the Curtis transaction. We haven't forecasted any additional. You heard Jenny talk about the pipeline, so there's always a balance of actionability and timing on that. But I would just restate what Jenny said. We're going to be active when it comes to deploying the balance sheet.
Okay, great. Thanks.
Thanks, Jeff.
We'll move next to Andrew Ovis with Bank of America. Your line is open.
Yes, good morning.
Morning, Andrew.
Just a follow-up on, all these exciting new verticals, power, AI. Is there any thought, how do you think about available capacity and your technology portfolio to ramp and expand your presence in these markets over the next several years? How much room is there to sort of grow organically or for bolt-ons targeting these specific high-growth verticals that are seemingly new versus where we were for the past decade?
Yeah, good question, Andrew. So we obviously, as I was saying, we've been working with some of the names everybody would recognize when it comes to data centers, and we've been working very closely with them globally to understand the capacity that is needed for our products. And it's it's another good example of how having this global footprint really helps us, because we can partner with these customers in the regions where they need us. In some cases, we can add shifts and add capacity, and in other cases, there's some other capacity increases that we'll have to do, but nothing of significant expense or nothing that doesn't have a real nice return to it. So constantly evaluating it and making sure that we're staying a bit ahead of it, as we always do, so we can really give them a good delivery and quality experience.
As we're sort of sitting at the bottom of the cycle, how do you think about the ramp over the next several years, and specifically labor availability, the need to train the labor, and any sort of inefficiencies as we go from multiple years of limited no growth to actually growing? How do we make sure that the ramp is smooth? Thank you.
Yeah, well, we rely heavily on our tools sitting inside of the Parker Lean system and on our our culture of Kaizen. That's where we really do get a lot of our efficiency improvements. And the way that we work with Kaizen and the way that we work with our teams, we establish how our production lines, how our assembly cells can operate at different volumes, and what that takes from a labor standpoint or flexing at other areas of the factory. So in many cases, we've been able to do that without adding team members, and in other cases, we will add team members as needed. But we put a lot of energy into onboarding and training new team members, and I think we have some really, really robust programs when it comes to that. So I think we're in a good position.
Andrew, this is Todd. I would just add, we did bump up our CapEx forecast for the year. That's higher than we've been historically. A lot of that is going towards automation, safety-related items, capacity in certain regions where needed. So I think we're being thoughtful about it, and I think we are obviously we're preparing for growth.
Thank you very much.
We'll take our next question from Nicole DeBlase with Deutsche Bank. Your line is open.
Yeah, thanks. Good morning, guys.
Morning, Nicole.
Just maybe circling back to, the really impressive aerospace margin performance this quarter. If we kind of look at what you guys are forecasting for the rest of the year, there is a bit of, a step down versus the 30%, and I know that's a really, robust result. But is that just because of the mix within the mix with what you said, Jenny, around spares shipments?
Yeah, spares are hard to forecast. So yeah, that would be the biggest part of it, Nicole. So
okay.
For Q2, we have margins at 29.1% for aerospace, which is a 90 basis point increase year over year, and obviously an increase from our initial guide.
Okay, perfect. That makes sense. And the incremental stepping up to 40% also really good to see. I know kind of the previous long-term target, or what's baked into the longer-term 2029 targets, is closer to 35. Could this possibly be a new norm for Parker, given how strong margin performance is, or do you still think it's best for us to kind of anchor to the 35% or so in forward years?
Yeah, Nicole, this is Todd. I'm glad to see those incrementals. They are very much impressive. As you know, they're not easy to get. There's a lot of work around the globe that happens to turn out these great results. Sometimes it's a little easier when the sales are, the math works a little funny when the sales growth is not enormous. But you've seen our margin expand, you've seen our EBITDA expand. But as far as what we hold our team to, we model that 30 to 35%. Of course, it varies depending on where you're at in the cycle. But I don't think we're ready to change that guidance yet.
Understood. Thanks, Todd. I'll pass it on.
Thanks.
We'll take our next question from Brett Lindsey with Mizuho. Your line is open.
Hey, good morning. First question just on construction. So you noted the gradual recovery. Is this predominantly the MRO piece of that business, or are you beginning to see a little bit of load-in from OEMs as they're seeing some dealer increases?
I think it's both.
A little bit of both? Okay.
A little bit of both.
Yeah, and then just to follow up on that last question regarding the fiscal 29 target. So the adjusted op target was 27%. The top end of the guide this year is 27%. So basically got there 3 years early. Should we think of this year as the new bouncing off point, and you're comfortably marching above that, or is there something about mix or discretionary costs that might need to come back?
Well, listen, we're really pleased to see what the team was able to accomplish in Q1, and very happy to be able to increase our organic growth forecast outlook from 3 to 4%. We do still have some markets that need to recover, and we think that what we have out there in the guide right now reflects what we see today. Obviously, we could not have achieved this 27% adjusted operating margin without the hard work and dedication of our team. But just a reminder, with the FY29 targets, adjusted operating margin is not the only target, and we're focused on achieving all 5 of those targets. There's still work to do there, but we're confident we're going to get there.
All right. Thanks a lot.
Thanks, Brett.
We'll take our next question from Nigel Coe with Wolfe Research. Your line is open.
Thanks. Good morning. It is still good morning. We've got a lot of ground, but I did want to go back to the aero margins. And I'm actually wondering, is there a way to think about legacy Parker aero margins and Meggitt? And through the question is, I'm trying to judge how much more runway there might be to operationalize the Meggitt margins.
Nigel, this is Todd. That integration has gone unbelievably well. We have certainly made that part of the Parker operating strategy. It is really hard to tell the difference between the legacy margins now and the Meggitt margins now. A lot of the synergies really came from across the group. And quite honestly, that's not the way we're really running the company now. It's not Parker Meggitt and Parker Aerospace. It is Parker Aerospace. I would tell you they're both stellar. Hitting 30 for the first time. It was equal parts of both. And, we've got a very bright future there.
Yeah. I think that's the right answer, by the way. And then going back to power gen, I think, Jenny, you mentioned, or maybe as you told, that roughly half of that 7% is power gen. So I'm actually curious, when would you think about, breaking it out as a separate reportable subsegment? It seems to be getting to the same sort of size as HVAC, so just curious on that. And then any more color you can provide on the exposures, and then I'm curious, the heavy duty exposure versus the arrows and maybe some of the smaller gas turbines. Sorry for the detail, but it'd be interesting to know that.
Yeah. So what was the first part of your question?
Breaking out the difference.
Oh, the difference. We don't look at the percentage on the market verticals as to when we can break out some sub-segments. We haven't gotten that far yet. So I really don't have a number in mind where it would become its own market vertical. Obviously, we're very bullish about the future of power gen, so it's something we continue to evaluate. But energy is an area, all types of energy we think belongs together. So no real plans to break that out yet. And I would say, maybe in a follow-up with Jeff, you could look at some of the other detail that you were asking for, but I don't have it available for you right now.
Sounds good. Thanks, Jen.
We'll move next to Nathan Jones with Stifel. Your line is open.
Good morning, everyone.
Good morning, Nathan.
I've got a quick follow-up on the gas turbine business. If I remember correctly, many years ago, probably up to nearly a decade ago, the OEM margins on at least some of the components that went into the gas turbine business were pretty low, and the aftermarket margins were pretty high. Just wondering if that's still the case, and that might be a little bit of drag as the OE side of that ramps up, or if that dynamic's changed over the last decade.
Yeah, Nathan, this is Todd. When you go back and try to compare Parker to a decade ago, it's very difficult. It's a totally different company. The margin expansion is significant. You see that every one of these businesses has been part of that margin expansion. We still have the mix between aftermarket and OEM margins. I would say that's probably always going to be like that. There's nothing here in power gen that dramatically sticks out that it's lower than the rest of the OEM aftermarket mix.
Fair enough. And then I had one follow-up on Mig's question earlier on the longer cycle industrial international orders. Any color you can give us around what drove those? I know they were maybe 4Q last year that they came in. And Jenny was giving us some cadence on how that doesn't phase in, I guess, to revenue this year, but any color you can give us on when that starts to contribute to growth in international? Thanks.
So the longer cycle orders that we had in Q3, I believe that were in our engineered materials business. And that longer cycle could be anywhere from 6 to 12 months. I don't have the details committed to memory on exactly what those were, but they did not repeat in Q4. So longer cycle, longer demand sense, anywhere between 6 and 12 months, I would say.
Thanks for taking the questions.
Hey, Chloe, this is Todd. I think we've got time for maybe one quick positive last question, if you could put whoever's next in queue.
Absolutely. We'll take our last question from Andy Kaplowitz with Citi. Your line is open.
Hey, good morning, guys. Thank you for squeezing me in here. This is actually Jose on for Andy. Maybe to wrap it up, you've talked in the past about mega projects and how they could potentially impact Parker. Curious if you could talk about how customers are moving forward with the mega projects. What are you guys listening from your distributors, and how are you approaching that trade-off between there's still a lot of larger projects out there, versus a somewhat still uncertain macro environment?
Yeah, and when I was talking about our distribution channel and how they serve all those small to mid-sized OEMs on capital investments and CapEx, those definitely are those mega projects. So we still see a very large amount of them out there. We still do hear that there are delays, but there's obviously some of these that are starting to kick off, and they're mainly focused on customers looking for productivity and efficiency. And that's what we're hearing from our channel that supports those customers, and that's where we believe most of that is happening today.
Thanks for the time.
Thanks, Jose. Chloe, I think we're running out of time, so this concludes our FY26 Q1 earnings release webcast. Like I said earlier, we appreciate everyone's attention and their time. We thank you for joining us today. Our investor relations team of Jeff Miller and Jen Stuckey will be available for the rest of the day if anyone has any follow-ups or needs clarifications. Thank you all, and have a great day.
This concludes today's call. We appreciate your participation. You may disconnect at any time and have a wonderful afternoon.